This is Bob, and Bob thinks that because he has bad credit that he cannot buy a home. So he's gonna use this false belief and use it as an excuse to not buy a home and never get started. Don't be like Bob. In today's video, I'm gonna explain why people think that you do need good credit in order to buy a home, and I'm gonna give you 2 ways that you can buy a home with bad credit. And if you are new to the channel, my name's Justin Yurong. I'm a real estate investor and entrepreneur here in Las Vegas. I've made hundreds of videos teaching people about real estate, and the goal of this channel is to help you grow your money and mindset. Also, if you wanna see more personal content, follow me on Instagram at Justin Yurong. So usually when people think that you can't buy a home if you have bad credit, they're usually thinking of the conventional lender. If you plan to use a conventional lender, they're gonna require you to send in a lot of information and personal documents for your financials. They wanna make sure that you're in good financial standing if they are going to give you a loan to buy a house. And really, there's a lot of reasons why a conventional lender will not want to lend to you. Maybe you don't have enough money saved up in the bank, or maybe you don't have enough income coming in. Maybe you have a commission job and you haven't had a job for at least 2 years because a lot of them require that. Or maybe you just have bad credit. And if you have a bad credit score, you probably have not paid your loan obligation payments on time, which you should, and I highly recommend for you to do that. Maybe you just don't have enough credit history, or maybe you don't have enough lines of credit to have a good credit score. But if you do have any type of credit history, any type of loans, like car loans or anything like that, make sure that you're paying them on time so that you do have a good credit score. Because if you do plan to use a conventional lender to buy a home, yes, somebody will need to have good credit in order to buy the home. And when I say good credit, I'm simply meaning credit that meets the minimum requirement for that lender in order to lend you money. But that someone doesn't have to be you. You can use another person's credit in order to qualify for a conventional loan. Like when I bought my first property, I actually did have good credit score, but I didn't have enough income to my name yet because I was working these minimum wage jobs. So I actually asked my sister to co-sign the loan for me, and she acted as the co-signer. We used her income. She didn't put her own money into the down payment or anything like that, but we did use her name to justify that we had enough income to support my first home purchase. The same exact thing can be done with credit. So if you don't have a good credit score, you can rely on someone who does have a good credit score and ask them to co-sign for you. But co-signing is only one strategy that you can use if you have a bad credit score and you intend to use a conventional loan to buy a property. You can also have someone else be the primary borrower for the loan and then just figure out a way between you and them to split the profits or the equity or the cash flow or whatever you decide to negotiate. But yes, even if you are using a conventional loan and you have bad credit, there are still ways to buy homes. That being said, if you do have bad credit, I do recommend for you to start working on improving it, just to get in the habit of paying people back on time. The good news is conventional loans aren't the only way that you can buy homes. Let me give you 2 other ways that you can buy a home even if you have bad credit. The first alternative financing strategy that you can use is hard money. And if you do not know what hard money is, they're basically these institutions who have a lot of money to lend for short-term loans for house flips or for properties. And these hard money lenders are very different than conventional lenders. Hard money lenders don't care about your personal finances, so they won't ask for your W-2s or your pay stubs or your bank statements. They won't ask for stuff like that like a conventional lender would. The hard money lender, they don't care about that stuff. They just care about the deal, which is why they're so great. But these hard money lenders typically lend for undervalued properties, and they usually will give loan terms of 6 to 12 months. So they aren't like these 15-year or 30-year mortgages like these conventional loans are. And they charge much higher interest than these conventional lenders. So typically interest rates for hard money lenders are somewhere between 8 and 14%. Very different than the conventional loans, at least what we're seeing today, somewhere between like 2 point something to 4%. And there's a wide range, but they're a lot higher than these conventional loans, and the reason is because they take on a lot more risk. Usually these hard money lenders are lending for house flips or properties that are in really bad condition that a conventional lender would not lend on. Hard money is essentially a loan product made for house flippers because they're these short-term loans. So if you find a good deal and you don't have good enough credit to qualify for a conventional loan, then you probably wouldn't even be wanting to get a conventional loan anyways. You probably would be seeking something like hard money because hard money just cares about how good the deal is. And another benefit to using hard money as opposed to conventional lenders is that they act as a buffer or a middleman. So for example, let's say you get a deal and you bring that deal to a hard money lender. You get it under contract, you bring it to them, you send your number numbers on what you think the ARV is, what you think the repair costs are, and what the purchase price is. They will then underwrite it, so they'll analyze it, and they'll figure out what number makes sense to them and if the purchase price makes sense for them to lend on it. And if they decide that the deal isn't a good enough deal for them after they analyze it, then it might be a good indicator to you that you're buying a bad deal. Their opinion often serves as a cautionary sign. And what I will say is that if you're a new real estate investor, don't knock hard money until you try it. When I was just getting started as a new real estate investor, I thought I would never use hard money because I saw these high interest rates and I saw they also charge a lot of upfront costs like points or service fees or stuff like that. And I thought I would never use these people. Why would I use them if we have conventional lenders at these lower interest rates? But as I've learned and as I've grown, I've discovered that hard money is extremely useful, especially for homes where you can't use a conventional lender to buy the home. Think of it this way. Let's say you find a deal and you find out that you can make $100,000 in profit on this deal, and you can't get a conventional loan on the property because the property's beat up, but you can get a hard money loan, which might be like 5% interest higher than your conventional loan. You're probably not gonna walk away and say, no, I'm never gonna use hard money, the interest rate's too high. No, you're gonna look at that and say, okay, maybe I have to pay 5% extra interest, but it gives me the opportunity to make $100,000 on this flip. That's how you have to see it. Hard money allows you to buy these homes where you otherwise couldn't, but that's hard money. The second way that you can buy a home with bad credit is to use private money. Now, private money is kind of similar to hard money, but it's also pretty different. Private money is typically money that comes from an individual or friends and family, people that you know or that know of you, who is willing to lend you money for these house flips. And the cool thing about using private money is that everything's negotiable as far as the interest rate that you're gonna pay them, or maybe even a profit split if you're planning to split the profits instead. You can also negotiate the time frame or anything else like that. But private money is very different than hard money in the sense that with hard money lenders, they have to have a checklist and they have to check all their boxes to make sure that the deal is good enough and that they do their due diligence, and that they have points they charge, they have systems where you have to pay 10% down payment or anything like that. Like, they have their system set up. With private money, they're usually just individuals, and so they just want to earn a return on their money, and they typically, not all the time, but they'll typically be cheaper than hard money. Again, not all the time, it just depends on the lender and what you negotiate, but there's a huge benefit to using private money as opposed to hard money. Because if you use private money, you have the opportunity to buy houses with absolutely $0 of your own money. Often, private money lenders are willing to lend on the entire purchase price of these homes that you buy, meaning that you have to come $0 out of pocket. Of course, these private money lenders have to do their own due diligence and their own research about the property to see if it makes sense to lend you all this money to buy a home. So they'll have to analyze the deal themselves to make sure that they understand what's going on. But the fact that you can buy homes with none of your own money is insanely powerful because that means it's scalable. And here's what I mean by that. Let's say you had $1 million in your bank, which I'm assuming you don't if you're watching this video. But let's say you had $1 million in your bank and you were buying homes in cash, or even if you're using hard money. So you're buying a lot of homes using cash or hard money where you're still having to put down payments on these homes. Well, you're limited by how much cash you have available. So even $1 million, you have a limit to how many deals you can do at one time. If you're using private money and using $0 of your own money because you're raising the entire purchase from other people, you can do an unlimited amount of deals. And by keeping your own money out of these deals, you also relieve a lot of the stress that comes with managing your cash and the cash flow when you renovate a home. I want you to understand that when you flip a home, you don't really get paid that fast, especially if you're actually doing a renovation on it. So if I were to buy a new home today and use my own money, whether it's hard money or just like my own cash to buy a home, and I wanted to flip this home, it would probably take me like 4 to 6 months to flip this home, and you don't get paid until the very end. So it might take 6 months to get paid. But during those 6 months, I have a lot of expenses that I have to pay for out of my own pocket, like contractors or the materials for the project. And it's a lot of money that you have to pay, and managing the cash flow can be tough, especially if you don't get paid until 6 months later. So that's why I say it's so powerful to use private money and have $0 of your own money into deals, because 1, you relieve a lot of the stress, and 2, you can scale it. And if you want to successfully raise private money, 1, I suggest you actually find a deal first, but maybe once you have a deal, use social media to raise it. I've raised all my private money from social media because I'm constantly sharing exactly what I do, how I'm flipping these houses, and sharing that I need money for these deals. So if you want to take advantage of this financing strategy, make sure you are building your own personal brand in the way that you want to be seen and known. Also, if you want help to grow your real estate business, whether you are brand new or if you already have deals under your belt, DM me the word coach on Instagram at JustinYou'reWrong. Peace.